So let's talk about one of my favorite topics, which is our trust fund buddies. So as you know, we've been involved in the battle on tax reform for the better part of a year, and I found this picture. I think it's a great picture. But you know, when I looked at this picture, I thought to myself, you know, I'm a movie buff. I like trivia and movies and stuff like that, and I thought, you know, I can't quite get it, but this reminds me of a movie. And I'm trying to think, what movie would this remind you of? Anybody? No? Anything else? Exactly. So, just as well I don't live in Ottawa. Okay, so let's take a look at where we are in tax reform. This gentleman is Jean-Baptiste Colbert. He was a finance minister for Louis XIV. And he said, the art of taxation consists in so plucking the goose as to obtain the largest amount of feathers with the least amount of hissing. So he understood, he's long before Morneau, and a lot more elegant in the way he said it as well. So where are we with tax reform? Well, what's being plucked? Income splitting of dividends was going to be eliminated from private corporations. Increase on passive income in a corporation was going to go as high as 71% when paid out as dividends. The pipeline planning that converted dividends to capital gain was being prevented. But where are we now? Well, income splitting is going to be allowed for people over the age of 65 to a spouse, which is actually a very big deal, because the main issue is accumulating wealth in a company, and ultimately when you retire, the ability to then make that part of your retirement income. It's not really so critical to split that income earlier. It is quite critical to split it when you're retiring. But if you don't do that, otherwise there's no income splitting going to be allowed unless you can prove that you've made a financial contribution or labor. So my guess is what we're going to see is more salaries being paid to spouses, when historically what we saw were dividends being paid to spouses. And the passive rules are going to stay the same as they were before, but you will potentially lose your small business deduction depending on how much passive income you have. So what we're going to look at is what some of those impacts are and what you might be able to do to mitigate them. And the integrated tax and passive income, even though it's not 71%, it could be as high as 56% in Ontario, roughly 54.5% in BC. Okay, so let's look at, before tax reform, we used dividend compensation in small business. If you had the access to the small business deduction, you could income split relatively easily with adult children or spouses. Well, presumably most spouses would be adults, right? I guess. You could accumulate passive assets in a CCPC, and you could recover certain taxes when you pay dividends out. It was reasonably efficient, and the small business deduction was not impacted by the size of the passive portfolio that you held. So now, it looks like in many cases it's going to make more sense to go back to paying salaries as opposed to dividends and start investing more into RSPs, or depending on your age, IPPs, which are better for people roughly over the age of 50. Over 65, we don't really have to worry too much. The income splitting is not going to be prevented. A CCPC is still a better structure because, interestingly, as one of the concessions they made, they lowered the tax rate on private corporations that earn less than $500,000 a year to 12%. But you start to lose that small business deduction for $5 of loss for every $1 of passive income you have over $50,000 a year. All right, so let's look at this. Does this really make much of a difference? The first thing is you need to have a different look at the way you would invest money in a company versus in other locations. So this is a portfolio made up of Canadian and foreign equities, real estate, a much higher allocation of real estate, insurance, which is not taxable on its earnings, preferred shares, private equity, and alternatives. This portfolio, what we wanted to do was say, okay, fine, let's backtest this portfolio for the last 5 years, look at the returns that we've earned, and how much of those returns were taxable, and assuming tax reform had been in existence 5 years ago, how much tax would we have paid in the last 5 years? So here are the returns. They've been pretty good. The markets have been reasonable in the last 5 years. So in each of these categories, if we go through them all, the one that really matters is the last one, the weighted average return of this portfolio, 9.3%, because there's very little fixed income in it. There are no low interest bonds or lower interest mortgages. It's all designed around equities and real estate primarily. So how much of each of these categories is taxable on their return? The highest is preferred shares, which is okay in this case because preferred shares get special dispensation under the new rules, and they are taxed at lower rates. So that's one of the exceptions. But when I put all of that together, the average blended tax rate, or taxable income of this portfolio, of the 9.3% portfolio, only 30% is taxable, which means my tax bill is 15.2%. So that would have been the corporate tax I would have paid on this portfolio for the last 5 years, assuming tax reform was in effect 5 years ago. And if I can pay 15% tax on that return, it's all good with me. It's not really an issue. It's not really making a difference. It's not as if people expected to pay a lower tax rate than that. But you need to have other fixed income assets. And ideally where you would put them is in tax-free accounts, like tax-free savings accounts, registered accounts, RSPs, IPPs, and for those of you that have charitable giving accounts or foundations, that as well. Interest-bearing and tax-deferred accounts. So when I put these two things together, I have the original balanced portfolio I want to have. On the left-hand side, I'm not paying any tax anyway, and on the right-hand side, my tax rate is 15%. So let's look at two taxpayers. Some of you in this room are old enough to remember how to play Monopoly. And I love this one because one of the worst squares you could land on is income tax. I find it humorous that the rate was 10%. And that was the bad square to land on. Okay. So let's look at a 2.2 million portfolio, which I picked for a particular reason, that number. And we're going to look at two investors. One investor is going to do a traditional 60-40, 60% stocks, 40% bonds. And the other one is going to take advantage of our redesigned portfolio, which is more tax efficient. And we're going to take a look. What is the overall tax and what is the overall tax rate going forward? Because it's going forward that we care about. So with a moderate risk investor, there's the total return on that $2.2 million, $140,000, of which $72,000 is taxable. Now the corporate tax is $34,200 on that $72,000, but this person's also going to lose $110,000 of their small business deduction, and that will mean that they're paying additional corporate tax of $16,500. The total tax bill with this portfolio is $50,000, 36%. The other portfolio, the total return is higher because we are taking a bit more risk here. The fixed income is in our registered portfolio. The taxable amount is considerably lower. So the corporate tax is $23,000. There's no impact in the small business deduction. There's no additional tax. So the total tax is $23,000, 13.8%. So the difference is 21% better return, 54% less tax. So we built a tool, because when we have nothing else to do, we build spreadsheets. So we built a tool that will allow us to sit down with our clients individually, because one of the things about tax reform is that it's not cookie cutter. Your situation is going to be different for each client, whether you take salary or dividends or a blend of them, where your portfolio lies, what your risk tolerances are. So we've built this tool to help make a decision about what we want to see that portfolio look like in that corporate environment. Now what if you get to the point where your assets are such that you are simply going to lose your small business deduction? What difference does it make over time? There's two tax rates now in BC, 12% for the low rate, 27% for the high rate. So with a low rate, if you have $100,000 of corporate income, you pay $12,000 in tax, you have $88,000 that you could save. If you're paying the high rate, you're paying $27,000 in tax, you save $73,000. So there's a 20% higher amount to save if you get the small business deduction, which is not insignificant. So let's see what happens. If we had a 6% return for 30 years, and we want to take out income, at some point we want income to come out of here because we want to retire and have a lifestyle. So of course, obviously, if we have 20% less savings and all the other assumptions are true, we're going to have 20% less cash at retirement. But that actually isn't the full story. So let's look at the wealth accumulation corporately. There's a 20% difference, but if I take 4% a year out of the small business corporation, I'm going to get a little under $300,000 a year. The tax is $63,000. If I take 4% out of the lower portfolio, I've got $250,000, but my tax drops to almost half of what it is in the other one, because I'm paying a lower tax on the dividends coming out of the corporation that paid the higher tax rate. So at retirement, there is a difference in my spendable income after tax, but it's not 20%, it's only 6.5%. So while there is an impact in terms of whether or not you lose a small business deduction, for a lot of people, it's a relatively small difference. So the planning factors include your corporate assets, your age, your business income, and your spending needs. And the whole point that we're trying to emphasize the most is this is where the planning comes in. Each situation has to be customized. And even if you have a model that works for you today, it will need to be changed and modified over time. It won't remain static. So the planning options we're looking at are salary versus dividends, IPP versus an RSP for those over age 50, insurance with or without leverage. With leverage is really very, very tax efficient. Your asset allocation model, and one last thing, prescribed rate loans. So one option you have here is to the degree that you have tax-paid capital personally, it makes a lot of sense to consider either using a trust or direct loans to spouses or adult children or even to minor children through a trust, because you can effectively income split with all of them on a very efficient basis. So in simple terms, if I had $1 million and I could make a 6% return, that's $60,000 a year. The way the rules work under the prescribed rates that are in effect now is 2% of that return, or $20,000 a year, has to be taxable to me, but $40,000 can be taxable to another individual whose tax rate is lower than mine. So this can be a very effective way of income splitting within a family. Now I want to do one last thing here, because a friend of mine called and said, you've got to talk about this, school tax. And of course, I don't really know a whole lot about school tax, but it's sort of like, I think the words were, this is another tax reform issue, John. You know, you got to get serious about this. So there were some interesting things. We've looked at a couple of things here with respect to this tax, and it requires more study. It's potentially quite impactful. So the difference is if you own a $4 million home, you're looking, that's when it starts at $3 million, you're looking at an additional $2,000 a year in taxes, which is not great on property taxes, but you can sort of live with that. But at $5 million, it goes up to $6,000 a year. At $10 million, it would be an extra $26,000 a year in taxes in 1 year, which is a 100% increase on your current level of property taxes. Now, the interesting thing about this property tax is that, first off, this is a tax that's not deductible, because it's property tax. Now, this is not applicable to somebody who owns a rental apartment. So one of your friends, speaking of, you don't want the other person to get rich. So let's imagine you have a friend of yours that owns a $50 million apartment building. They're not going to be paying any additional school tax, even though they have a $50 million building. And if you own a commercial, industrial, or retail property, the same applies there. This tax is completely targeted to homeowners. So one of the things that's happening here is there's a town hall meeting May 1st, 6 p.m. I just wrote this down today, so I sure hope I got this right. St. James Community Square, 3214 West 10th Avenue. I think I know this building. My guess is that if you don't get there at 5:30, you're not getting in the room. So I think there'll be a few people there. I find it interesting that the MLA that represents West Point Grey is David Eby. I don't know how David Eby got elected in West Point Grey. I have no idea how that actually worked out. But anyway, he's going to be the one defending this tax. So if you have something to say, you should be there. And if you can't be there, you should consider, if you're distressed by this tax, to start writing, because that's basically how tax reform got turned backwards. It got turned around on the basis of just a lot of town hall meetings and a lot of people writing. So to sum it up, Rob talked about good and bad neighborhoods. We talked about treading water. We're in an environment where it's a bit like swimming upstream, so we have to look where we can add value. There are going to be disruptive technologies, and we have to figure out how we want to build them into portfolios. And managing tax reform is something that's going to be a sort of an ongoing effort, and we've built some tools to help you get that done. So with that, we are finished. I want to thank you for the time here. Rob and David and I are going to come back in 5 minutes' time, but we think we should let you escape for those who would like to get your glasses refilled. Thank you.